Hi, this is Professor Cummings, and this is part 3 in our student debt series. So in the first one, we actually went through and discussed what is a bubble, because we keep hearing this term student loan debt bubble. So again, a bubble is a rapid escalation of prices followed by a contraction. Now, the original definition was a little bit longer. If you want to see that, you can watch the first video, and I go over different examples of bubbles and what the definitions are and what qualifies as a bubble. Let's see, we also discussed what people do during a bubble, which is they become highly leveraged in something that is actually going up. So a lot of times, like in the tulip bubble, people actually were taking out loans on, to be able to buy more tulips, during this jubilation of tulips. Let's see, we also discussed why people go into debt. This was in part 2. Debt allows you to make purchases or leverage future income into the present. So again, the reason you can mortgage a house, the reason you can live in a house or buy a car is because we've got this concept of debt. You can take out a loan for money that you haven't earned yet or that you might not have, and you can actually purchase something right now and just pay it down as you go. And we also talked about some of the downsides of debt. Debt can potentially grow more than was expected. So again, this goes into some of the definitions, like the terms of the loan, some of the concepts of how interest is calculated, simple versus compound interest. And if you don't understand those, you can end up paying debt or paying interest in ways that you didn't really prepare for. So in this particular video, now I'm going to show specifically about student loan debt, since we do have a student loan debt of $1.5 trillion as of today, or as of right now, probably, and still growing. And one of the biggest problems that people have with student loan debt is that they oftentimes don't understand what the debt was, what that meant, what it meant to be in debt, what it meant, the whole concept of how debt works. So they were generally unprepared to go into debt. And when they came out with that debt, they didn't know what to do, and they didn't understand why the payments were what they were, and what some of the stipulations were. So basically, they didn't understand how they got in the situation they were in. But here's one thing, again going back to the first video, what it is about debt, the second video. So what it is about debt. So debt allows you to make purchases or leverage future income in the present. And that essentially is what student loan is. You going away to a college. You can't afford it right now. You don't have the money to pay for it outright. So you take out debt on the idea, on the belief that you will pay this debt back at the end of a certain term, a certain number of years, to pay for what you did for 4 years. Usually this is based on an income that you think you'll make because of what you did in those 4 years. Went to college, got a particular degree, or some other thing that you expect to happen into the future. So let's look at a scenario. We'll have a hypothetical student here, and his name is Joe. Joe is going off to college. He's 18 years old. He was accepted at a state college in a 4-year program, and he has no money going into this. He's paying for it all on his own. His parents can't help him or won't help him. He doesn't have any scholarships, so he's going to fund the whole thing on debt, on student loan. And in order to make it out of this college, though he may work some, he may do some other things to make some money that he doesn't have right at the moment. But what he's going to do at the end, he's going to have, or expected to have, $40,000 in student loan. Now that is a very consistent number. I think the average student has $37,000 in student loans right now. That's what's averaging right now. And so that puts Joe right into the middle of the bell curve of getting student loan debt. So if he graduated at $40,000, or he took out $40,000 of student loan debt, he would be right on track with the average American student. So let's go through what Joe's going to have to do, what decisions he's going to have to make. So again, Back in the second video, part 2, I discussed this as far as some things to keep in mind when dealing with debt. So again, remember, debt gets calculated, and there are 4 things that you want to understand when doing those calculations. The first one is the amount of interest that you're going to be paying on that debt. That's the interest rate, how fast that debt's going to be accumulated. This is essentially what you're paying the lender to use their money. Also, something that greatly impacts how much this is going to cost you is the time, or sometimes called the term. I like to keep these 2 terms separate, but the time, the number of years that you have this debt out. Now then there's the terms, or I could call this terms and conditions. So these are the rules, the stipulations, all of the conditions that they're putting onto this loan to make sure you pay it out or pay it back, and well as how they're going to hold you accountable. So not just the amount of time and the amount of interest, but anything that goes along with that. And then, of course, the most obvious one is the principal. This is the amount of the loan that you're going to take out. When you think of those 4 things, particularly the interest, time, and principal, you can figure out how much you're going to pay over the life of that loan, and understand how much you're going to pay, what the rate's going to be, what your monthly payment's going to be. And if you understand this one extra one, the terms or terms and conditions, now you can understand all of the little gotchas, and I hate calling it that way, but the blind spots that make the loan go from a simple interest payment process to something that could potentially put you into a precarious situation financially. And it goes back to, a lot of people complaining about the fact that they didn't fully understand the debt or the whole concept of the student loan. So here's some options, and I'm going to keep this basically simple. Keep this relatively simple as far as our example we're going through today. Joe's got 2 general choices. One is a federal student loan, a student loan that is backed by the federal government, also known as guaranteed student loan. And the other one is a private student loan. Now, let's go through some of the differences here. When you get a federal student loan, you've got 2 choices. You can get a subsidized or an unsubsidized. Now, what those terms mean is that in a subsidized loan, you don't start paying interest until after you graduate or after you leave college. There's usually a grace period of about 6 months, but up until then, they'll give you the money in your freshman year, your sophomore, junior, senior year, and you aren't paying any interest on their money. You just have the principal, and you use that money to pay for school, pay for your supplies or whatnot. You can also get a subsidized student loan. In this particular case, you are actually paying interest from the time you get the loan. So the whole 4 years you're in college, 4 or 5 years you're in college, you are paying interest on that loan. So your freshman year, you get a certain amount of money, you're paying interest. Sophomore year, junior year, senior year, you're accruing interest during that entire time. Now, some of the stipulations, they both have the same, or a fixed rate of interest. They both have a standard repayment plan, these federal loans. The primary difference between the 2, like I said, one is that one actually starts accruing interest, an unsubsidized, when you get it. One actually doesn't until after you graduate. There's also a difference in terms of how they qualify you. One is based, the subsidized is based on your financial need. There's actually a means test. They see how much you make, how much your parents make. If you're a dependent, you fill out a lot of paperwork, and they grant you a student loan based on that amount. A unsubsidized is not based on your need. So it's much easier to get this type of student loan. And in both cases, it's possible to do a modification of your repayment plan. Now, I said in the above one that you can have a standard repayment plan, which for federal student loans is usually 10 years. Right off the bat, you've got a standard repayment plan of 10 years. They amortize it out to a 10-year, and then you're debt free, or you've paid that loan off. If that doesn't work for you, it's possible to modify that repayment plan, and there are several different ways to do that. Now, the alternative is a private student loan. Now, this is a loan that can actually cause some problems. This is done through banks, through lending institutions, credit unions, whatnot. And those terms and conditions are set by the lender. So everything about that loan is going to be set by the lender. Nothing to do with the federal government. This is in a case where you can have variable interest rates. The interest rates are usually higher, and your repayment plan can actually be higher and be a little more complicated. Most people opt for federal student loans, but there are some people that get private loans. And for the sake of this discussion, we're going to have Joe get a federal student loan. Now, all the information, like I said before, I'll give you all my sources. You can look this up right on studentaid.ed.gov, and they'll go into a lot more detail than I'm giving you. I'm giving you a working example right now based around Joe. So again, since we are talking about college, now let's consider these 4 things. So I told you the 4 things that we have to keep in mind. And now we have some information that we can work with. Federal student loans, again, you can look this up as of now. You can get those for 4.53% interest. Like I said, there's a standard time to pay it back of 10 years. Now the terms on this one, the terms and conditions is it's a fixed payment or a fixed interest rate, and it is simple interest. It's not compound. A lot of people don't realize that. And we already said that he's going to get a principal of $40,000. So we got everything we need to know to start calculating what's going to go on with Joe. And again, same source. So again, like I said before, federal student loans are simple interest. And again, in part 2, we discussed how to calculate that. And again, it's a very simple calculation. The interest is calculated and paid off. The interest is not normally capitalized, or it's not meant to be capitalized based on this equation. You've got your principal times your interest rate times the number of years that you're going to be paying. And that's how you can calculate your interest. Now, keep in mind, there's something else that goes on with this. It's your amortization schedule. So again, your interest is being calculated on the unpaid balance. So your balance is going down. And so you're paying more and more of the principal as the loan goes on over the course of those 10 years. And that's what's going on with that amortization rate. And that's why your payment is going to be fixed over those 4 years, or excuse me, those 10 years. So let's keep that in mind as we go forward. So a few other things about student loans. So there's other things that can trip you up, in terms of those terms and conditions. Number 1, again, federal student loans can't be bankrupted except for very specific circumstances like a disability. So that's one thing to keep in mind. So you can't bankrupt them. You can't, have basically nothing you can do that can get out of it except for paying it off. So, disability or death. There are loan forgiveness programs. So if you have certain majors and you go into certain types of employment and you sustain it for a certain amount of time and consistently pay your loan, it's possible that they can forgive your the balance of your loan after a certain amount of time. Again, we said before, it is possible to modify your loan repayment. Again, that is something that you can do. I said that earlier. If you do go through either of those programs, the forgiven balance could be considered income. So if you have $40,000, you go into, let's say Joe goes into a program where he can be forgiven. So he teaches in inner city schools. And after a certain amount of time, they forgive the balance of his loan. They end up forgiving, $5,000. Well, Joe will have to count that $5,000 as income, and on his, like a regular piece of, almost as though he was given a check for $5,000. Now, if you do have fees, you do have late payments, you do have interest on student loans, they can be capitalized. What does capitalized mean? It means they can be rolled into the balance, the remaining balance of your loan. So if at some point in time during the course of paying off his $40,000, he has to, has a period where he can't pay because he's sick or he loses his job, he's unemployed, and he's still accruing interest, that interest, which he isn't paying, is being rolled into the balance. That's what capitalization is. And if you're in an unsubsidized loan, again, remember, you're accruing interest the whole time you're in college. And that is considered a deferment. And that whole 4 years you're in college, that deferment is being capitalized. So you're not paying in those 4 years. Their payments are deferred to the end of 4 years. But you're still getting interest, and this is capitalization. So let's look at what Joe did. Here we have a website called credit.org, where I went to, and then there's also a second one called nerdwallet.org. Both get you the same numbers. I actually looked at them both just to double check before I made this video. And I put in our stipulations for Joe. He's got a principal of $40,000, an interest rate of 4.53%, and it is 10 years. All right, $40,000, 4.53, 10 years. It's simple fixed interest, calculate simple fixed interest. And you can see is the amortization. He will spend $49,816 or pay back, $49,816 over the course of those 10 years. And he'll have a monthly payment of $415 off of those $40,000. So at the end of those 10 years, he would have paid almost $10,000 in interest. So almost 25% more onto just interest, just to use that money at this particular interest rate. Now, if he had had an unsubsidized loan, he would have been accruing interest while he was in college. So that would have been an extra $4,700. His new payment would have been $464. So just about $50 a month more. But over the course of those 10 years, because of that interest that he was accruing while he was in school, during those 4 years that he didn't pay down and it got capitalized into the balance, he would have paid an extra, or would have paid $15,000, almost $16,000 in interest. So about 50% more, so a good amount more than what he would have paid before. So in our next video, we're going to answer a few other questions, and some of these are going to be, why do some people's student loan balance keep going up? The example that we did with Joe just now was a pretty straightforward example. It was a subsidized or unsubsidized loan, both scenarios. And, Joe had, assuming no hiccups, and in the course of 10 years, he would have paid that off. We didn't say what major he was doing or how much his income was. So we just made the assumption that everything was going to go without any issue. But yet we've heard several stories, or I can tell you several stories of people paying down their debt and wondering why their loan balance either stayed the same or didn't go down at all, or even went up. Now, what if the loan payment is not affordable? Well, there are scenarios where that happens. And like I said, there's different types of loan repayment plans that we can talk about. I didn't want to put that in this video. How does capitalization impact my loan? Again, I showed you the difference between subsidized and unsubsidized, but I'll go into other details in the next video. And then what are alternate repayment plans? Again, what I was talking about in the previous slide. So there are other ways that you can pay if they're if under other circumstances. So again, this is Professor Cummings. Thanks for watching, and like I said, I'll put out another video soon where I go through and answer some of these questions. So something other than the very simplistic scenario I did with the fictional character Joe. And thanks for watching.